Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at WOK Medical.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So we've got a fascinating stack of financial filings, some analyst reports, and a highly speculative white paper on our desk today.
Yeah, it's quite the mix of documents this time.
Right. And our mission is to figure out if WOK Medical's insane recent pivot is, the actual future of healthcare or just a mirage.
It's a huge question because, imagine a company that makes basic hospital masks suddenly declaring they are a Web3 artificial intelligence powerhouse.
Exactly. It sounds like a joke, but let's jump right into the market frenzy that unfolded on May 11, 2026. If you were watching the tickers that day, you saw something completely wild happen.
Oh, absolutely wild. We are talking about a massive sudden explosion in price.
Yeah, the stock surged 206.25% in a single day.
It was incredible to watch, really. We saw an intraday swing from 19 cents all the way up to $4.09.
Just massive volatility.
Right. For a stock that has been largely neglected, is trading in the doldrums for months, this was a violent breakout. And it was all triggered by a major announcement regarding a partnership with Nova BioPlus.
But what makes this so fascinating is the fundamental reason behind that surge. You have to understand what this company actually used to do.
Which wasn't AI, that's for sure.
Definitely not. Historically, they were a manufacturer of traditional, low-margin medical consumables. We are talking about face masks, breathing circuits, just extremely basic hospital supplies.
Very commoditized stuff.
Exactly.
Yeah.
Then suddenly they announced this wild strategic shift. They aren't just making masks anymore. They're positioning themselves as an AI-driven healthcare and Web3 ecosystem builder.
It is a complete reinvention.
Right.
They're taking traditional biology and colliding it with digital assets and artificial intelligence.
It's a bizarre mix.
It is, but to put it in perspective, it is like a company pivoting from printing the physical paper for books to suddenly owning the artificial intelligence that writes the novels.
Oh, wow, that's a great way to put it.
Right. They were abandoning the low-margin physical commodity to try and own high-margin intellectual property. It's the kind of narrative shift that just forces the entire market to reevaluate a company overnight.
All right, let's move into the wealth building context.
So when we look at long-term portfolio growth, it's crucial to understand why an investor would even consider looking at a highly volatile microcap turnaround story like this one.
Because it seems way too risky on the surface, right?
Yeah, exactly. But in wealth building, there is a concept of adding high beta thematic asymmetric bets to a broader portfolio.
Let's unpack that for a second, because high beta thematic asymmetric bet is quite a mouthful. Essentially, we are talking about a lottery ticket in the biotech space, right?
Essentially, yes.
Like, you absolutely do not bet the house on a microcap undergoing a transition this extreme. But if you allocate a very small calculated amount, the potential for a massive fundamental re-rating makes it a fascinating play.
That's the asymmetric part.
Right. You risk a very defined small amount to potentially make multiples of your initial investment, provided the turnaround actually takes hold.
Exactly. You might have your stable blue chip core, but you carve out a tiny percentage for these thesis-driven ideas. And the thesis here aligns perfectly with current macroeconomic trends.
Which are heavily tech-focused right now.
Yep. Right now, macro liquidity, meaning the massive ocean of capital sloshing around the global markets, is aggressively seeking out AI and Web3 narratives.
Everyone wants the next big AI play.
Exactly. Capital is flowing away from traditional manufacturing and pouring towards software, data monetization, and artificial intelligence. By repositioning themselves right at that intersection, they are giving that roaming liquidity a very specific thematic target to latch onto.
Now let's look at the fundamentals.
And the fundamentals show exactly why this transition wasn't just a fun experiment. I mean, it was a matter of basic survival.
Yeah, the legacy numbers are genuinely grim. If you are looking at their balance sheet right now, you're probably wondering how they are even keeping the lights on.
It's not pretty.
No, it's not. If we look at the full year 2025 revenue, it hit $9.85 million. That is a 14% decline. First half 2025 revenue was also down 14%.
Which is a terrible trend.
And furthermore, their operating cash flow currently only covers 1.6% of the company's total debt. They're carrying a debt-to-equity ratio of over 30%. From a purely analytical standpoint, the traditional mask and breathing tube business was just bleeding out.
It was. But there's a very strong bullish silver lining here if you look closely at the margins. Yes, the top-line revenue declined, but the company's net loss actually narrowed significantly.
Wait, really? It narrowed?
Yeah, it shrank by 69% year over year, down to $1.07 million.
Okay, which tells us that their cost-cutting measures are actually working. They are creating real operational efficiencies.
Exactly.
By aggressively trimming the fat from that declining legacy business, they are establishing a much leaner baseline. And that lean baseline is exactly what they need as they pivot toward these higher-margin tech initiatives.
They definitely needed to make some aggressive survival moves, though. Management had to execute some really painful tactics just to maintain their pulse and stay listed on the exchange.
Oh yeah, the dilution.
Right. They priced a $2.9 million registered direct offering, and to maintain their NASDAQ listing compliance, they were forced into a 1-for-100 reverse stock split on December 29, 2025.
Let's talk about that reverse split, because
Yep.
that is brutal. When a stock falls below $1 for too long, NASDAQ threatens to delist them.
And nobody wants that.
Right. So the company magically turns 100 of your shares into one share to artificially boost the price. That kind of capital restructuring is incredibly tough on early retail shareholders. It basically wipes out their share count.
It's devastating for the early guys.
Yeah, but from the company's perspective, it was practically mandatory to secure the liquidity needed for this new strategy.
It buys them the runway they desperately needed to build their new competitive advantage. They are shifting away from low-barrier medical supplies where literally anyone with a factory can compete, and they are building a proprietary data moat.
The data moat, let's get into that.
Yeah, they recently invested $1 million for a 10% equity stake in Neologix Bioscience.
Okay, I have to challenge that a bit. In the biotech world, $1 million usually barely covers the electricity bill for the lab. Are they just buying a flashy press release here, or does that actually buy them tangible infrastructure?
It's a fair question, for sure. What that $1 million gets them is direct access to shared animal research facilities and, more importantly, multidimensional biological data resources.
Interesting.
It's a data model application trinity. If they can successfully commercialize these exclusive biological datasets, it creates massive switching costs for any biopharma clients that decide to use their platform.
Because the data is so ingrained in their models.
Exactly. That completely insulates them from traditional medical device competitors. It's not about the physical lab. It's about owning the data generated inside it.
That brings us to the catalyst timeline.
This is where the story accelerates over the next 3 to 6 months. The centerpiece of this timeline is the introduction of the BioToken framework.
BioToken. So
Yes, the plan is to tokenize AI-generated molecular designs and biological research data. They basically want to create verifiable digital assets out of pharmaceutical development data.
okay, I hear the words BioToken and digital assets, and my immediate practical question is, how does this actually translate to real-world revenue?
Yeah.
Like, how do you tokenize biological data, and why would anyone pay for it?
Think about how traditional pharmaceutical companies operate right now. They guard their research like state secrets.
Very true.
It's siloed, it's expensive, and sharing it securely is a massive logistical nightmare. By tokenizing this data on a blockchain, Work Medical can actually license out specific, verified pieces of AI-generated molecule data to competitors or researchers securely.
Ah, I see.
The token acts as an immutable proof of ownership and a smart contract for licensing. It creates a brand new, frictionless revenue stream from data that would otherwise just sit on a server somewhere.
But the market won't just take their word for it. That is exactly what investors will be looking for in the upcoming earnings reports. People are going to be watching those SEC filings like hawks.
Oh, absolutely.
They want to see the transition from concept to cash flow. Specifically, everyone will be looking for initial R&D spending allocations or forward revenue guidance that is directly tied to this BioToken initiative.
Right. And there is also a very concrete physical catalyst on the horizon which provides some much-needed grounding to this whole Web3 narrative.
Which they desperately need.
They really do. They recently received manufacturing approval for an AI-automated human blood cell morphology analyzer. The commercial launch and manufacturing for this physical device is slated for the first half of 2026.
And they have set an aggressive sales target for it, right? 10 million RMB.
Yes, 10 million.
Hitting or missing that specific target is going to be a massive near-term catalyst. It will prove whether their AI hardware capabilities can actually generate tangible sales. Hitting that target shows the market they aren't just selling a story, they're selling actual technology.
Now let's pivot to the chart.
And looking at that chart, the technicals right now are defined by extreme, almost violent volatility.
The speculative momentum is staggering. On the day the BioToken partnership was announced, we saw a historic volume spike.
Unbelievable volume.
Yeah, the stock was trading at an incredible 210.4 times its average daily volume. Think about that. That is a massive tsunami of retail and momentum capital flooding into the order books all at once, driving that 206% surge.
But we have to look at the immediate aftermath of that surge, because this is where the caution flag comes out. The whiplash was brutal.
It really was.
The very next day after that massive breakout, pre-market trading saw a pullback of 47.7%, dragging the price back down to $2.05.
Profit taking is inevitable when a stock gaps up that violently.
Sure, but it wasn't just a one-day phenomenon either. Argus tracked another session where the stock made a peak move of plus 58%, which was then rapidly followed by a 33.42% decline.
The intraday selling pressure is intense.
Extremely intense. Furthermore, if you look at the broader price structure, the stock is still trading far below its pre-reverse split 200-day moving average.
Which acts as a massive psychological ceiling.
Exactly. When a stock is trapped under a major moving average like that, every sudden spike becomes highly vulnerable to sharp profit-taking by trapped historical holders.
They just want out.
Right. Imagine you bought this stock a year ago, you suffered through the reverse split, your portfolio is bleeding, and suddenly the stock spikes 200%. You aren't sticking around to see how the AI pivot plays out. You are selling instantly just to break even and get out. That creates a massive wall of resistance.
So what does market sentiment look like?
It is a fascinating disconnect. If you look at traditional analyst consensus, it still overwhelmingly holds a sell rating.
Because those traditional analysts are looking at spreadsheets that are entirely backward-looking, they are evaluating the company based on its failing medical device manufacturing history.
Yep, they are totally missing the pivot.
Their models just haven't been updated to price in the AI and Web3 transition.
But if you look at the real-time retail momentum flags across financial news feeds, the sentiment is overwhelmingly bullish.
It's like two different worlds.
The quantitative scanners are picking up massive volume deviations and significant gap-ups, which are classic signs of accumulation and momentum breakouts. All of this is being driven purely by the enthusiasm surrounding the Shanghai NovaBio Plus Biotechnology Cooperation Agreement.
There's also an interesting development regarding insider confidence. The company executed a capital restructuring recently where they sold new Class B shares specifically to an entity controlled by the chief operating officer.
Oh, that's interesting.
Yeah, this maneuver consolidated voting control. While it's not a traditional open market purchase, it tightly aligns the insider's control with the success or failure of this new strategic direction.
Puts their money where their mouth is.
Exactly. The broader shareholder base also approved this sweeping capital restructuring, showing that even the folks holding the bag from the legacy days are on board with the pivot.
And we cannot ignore the speculative rumors that are currently floating around the market, adding serious fuel to the sentiment fire.
Rumors are everything in this space.
They really are. Based on a co-authored asset tokenization white paper that the company disclosed on May 1st, there is intense speculation about potential crypto exchange listings for these new biotokens.
There is also talk about integrations with DeFi protocols.
DeFi?
Yeah. And for those less familiar, DeFi, or decentralized finance, essentially means they are looking at ways to allow investors to fund, trade, or stake these biological assets directly on the blockchain without traditional banks or brokers involved.
Wow. But speculation being the operative word there, right?
Right, speculation being the operative word. Nothing is confirmed, but in a market like this, the narrative alone is moving the needle.
Now let's talk about the risks.
And the risks here are severe. We have to bring out the heavy artillery when discussing the bear case, starting with shareholder dilution.
It's the elephant in the room.
It really is. This company has a brutal history of diluting its investors. We have seen a 320% increase in shares outstanding over the past year alone.
That is insane.
When you combine that with an operating cash flow that barely covers 1.6% of their debt, basic math dictates they are going to run out of money soon. They will inevitably need to raise more capital to fund this expensive Web3 pivot, which means the risk of further dilution printing more shares and devaluing the ones you currently hold is looming large.
Dilution is a real concern, but we have to weigh that against the execution landscape.
The execution risk is just as massive. The BioToken initiative is highly early stage. Management has provided zero concrete financial terms.
So it's all just an idea right now.
Basically, there are no hard commercialization timelines. And look at the ring they are stepping into. They are trying to build AI-driven biological models. That puts them in direct competition with heavily backed giants in the space.
You mean companies like Certara, Schrödinger, and Recursion Pharmaceuticals?
Yes, those companies have billions in backing. WOK Medical is entering this fight with a $2.9 million capital raise.
But here's the bullish rebuttal to those very valid concerns. Those massive risks are already largely priced into its current microcap valuation.
Because it's been beaten down so much.
Exactly. The stock traded in a neglected sub-dollar range for a long time. The recent capital raise and the reverse split, however painful, bought them the immediate runway they needed to maintain compliance and start building. And here is where the Web3 pivot really shines. The operating leverage of digital assets is incredibly high.
Once it's built, it's virtually free to scale.
Right. It costs almost nothing to reproduce or license a digital token once the initial framework is built. They don't need to conquer the entire market. Landing just one major biopharma client or securing one joint investment for their tokenized datasets could rapidly flip the company to profitability.
So with everything on the table, what's the final verdict?
Officially, the research points to a bullish score of 6 out of 10. The high speculative upside is undeniably there, but it is heavily balanced by those severe execution and dilution risks we just discussed.
It's definitely not for the faint of heart.
Definitely not. From a long-term investment view, this is absolutely not a buy and hold forever play. The strategy here is a swing trade with a 3 to 6 month horizon.
So you're playing the momentum.
Exactly. The goal is aimed specifically at capturing the momentum leading into the first half of 2026, targeting the AI Analyzer product launches and the upcoming BioToken development milestones, while keeping a very close eye on any capital raise announcements.
And, think about this before you go. What if, in 10 years, the most valuable healthcare companies don't actually make drugs or devices, but just own the blockchain data rights to the biology itself? It's a completely different paradigm to explore.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $110K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.